Hello student, welcome back to IBS. Today we are going to learn about another part of balance sheet in which we are going to learn about factoring in detail. That is also very much useful when you are creating financial report. Okay. Also this is applicable for USA Pay, USA May. Okay. They are there, but that is not that much detailed as I'm going to explain, because this will be your practical learning and this will be applicable and useful to your job also. Okay, so let's jump to the topic. Okay, so first of all we will learn about the factoring, what exactly factoring is. So let's read it out. Factoring, an immediate source of cash. So when we do factoring, basically when we need cash and we are struggling to get cash from bank or something, so at that time we go ahead with factoring procedure. Okay, and factoring involve selling account receivable. So basically here we are selling our account receivable, the receipt we receive from our customer or client who has given us a note with promise that they will pay you this much amount of money after this credit period of time. Okay, so either you can give him discount and tell him I will give you 2% and 5% you can pay me immediately. So if they will pay, that is okay. If they are not ready to pay, they want to take credit and then you need cash, for that you can go ahead with factoring. Okay, so there is a factoring bank. Actually there is no person, normally it is a bank who buy your account receivable, and you will lose all your ownership with regard to that account receivable. Okay, so once he will buy your AR or account receivable, he has right to sell it and to any of other company or other party. Okay, based on collateral basis they can also sell your AR, so they can do whatever they want to do. You have no right once you have done with your factoring. Okay, so this is the main important factor. And another quality with regard to factoring is not pledging. Okay, in pledging we will buy back those things. Okay, but in factoring we sold our account receivable, so in return what we will get, we will get immediate cash. Okay, so that is the difference. When you go and pledge your account receivable and get some fund, so that is not factoring, that will be called as a account receivable financing or account receivable pledging, but that will never be called factoring. Factoring has 2 3 limitation. First is you sold with your ownership. Okay, and you cannot buy back, and you will get return in cash. Okay, immediately. And okay, what is factoring? By definition, selling account receivable to the commercial finance company, the factor, that is called factor, to obtain cash quickly. This is the main intention. Process, the factor provides a loan collateralized by receivable. So he is giving you cash actually, and in return he is getting collateralized receivable and collect the payment directly from the seller to customer. So what they are trying to say, when you sold your account receivable, so your customer will not pay you, they will directly pay you to your buyer. Okay, so as you can see, this is the issuer. Okay, your client. Okay, you are giving him product or service. Okay, so based on product or service he is giving you promise. Okay, currently he is giving you promise to pay you after 60 days, 30 days, whatever it is. So you have now confirmed account receivable. Okay, approved AR. So now you need money. Okay, so either you can give him discount 2% if it is invoices for 1000k. If you tell him you pay me 98,000k, I will be write off all your due. Okay, so that is where you can get money if so. But in case of factoring, you cannot get it from here, or you cannot get it from bank also. Okay, or maybe bank is taking time, you need immediate money. Okay, maybe you are having some new opportunity or something, or any kind of expense you have, you need to pay your payroll and rent, many things. Like for example, when you have service base basically for payroll company, so payroll cost may be going in thousands of millions of dollars. The margin is based on this. You may charge only 1000k for a total billing. Okay, that will be your profit. Maybe after tax and all you will get only 60,000k, and but the huge amount you have to park into that or hold or fridge for that particular business. When you, but for on behalf of client you have to pay your payroll cost. Okay, for your client, and then after billing you will get, after 30 60 days they will pay you the money. So for those holding period, client has given you this service for that reason, because they want to hold their payment, they want to keep those funds, and you got this business because of this reason. So that is why this is the basic understanding. So he will not be ready to pay you your bill and clear your invoices based on that much percentage. So obviously you have to either go with bank, or you have to factor your AR, so that you can easily generate your money, okay, cash money, or I would say liquid asset. So for that you found a particular factor or investment bank or whoever it is, so they will take your AR in hand, okay, and you will lose your authority kind of stuff that will come later, we'll discuss. And then he will pay you certain amount, okay, and he will deduct some kind of factoring fees, okay, and also they will reduce some other risk related stuff in case of bad debt risk, okay. And another risk is sales return. If it is product or something, if product is not been liked by your customer, he will return. So he will return to you, but he need to pay directly to this factor, so he will deduct from his amount, right? His amount will be reduced. So that is why he will consider these are the risks. For those risks he will also reduce. So he will take two things, factoring fees, because he is paying you money in advance, so for 30 or 16 days before, so that you can use it. For that he will charge you a factoring fees, as well as interest he will also charge if you they normally pay and into your factoring bank account, but they will hold it until your average invoice clearing period. Maybe your invoice clear in 25 days or 30 days, you will normally get your money. So average AR period basis they are hold, still money is available, you cannot take out that money. If you will take out, you have to pay the interest for whatever percentage it has been decided based on that for number of days before you are taking. From average day is 25, if you are taking it day 0, so for 25 days you have to pay interest also. So these are the expense you have to bear, and after reducing that you will get your actual money, okay. So this is overall the understanding with regard to factoring. Now they are asking why we do factoring. Obviously we know to generate cash quickly and maintain our office expenses. Okay, we will move to another slide. So what are the conditions based on that we will consider this is purely factoring. Okay, so there are three major concept: transfer asset, isolate from transferor. So the person is the company, he is factoring, okay, so he will transfer his asset and isolate from this asset. The AR is now his asset, AR is not his asset, okay. He will in return he got the cash, so cash is asset now, okay, and he lose his AR and he has isolated that, okay. Transfer has right to transferee has right to sell, pledge and the asset, okay. So he has now right to sell further this AR or pledge whatever he want to do, he can do it. No side agreement, no side agreement between transferor and transferor to buy back. So this guy, this company, maybe IBS, he cannot buy back from him, okay. In return he cannot take this AR, okay. So this is not possible. So these are the three conditions we have to fulfill, then it will be called factoring, okay. There is two different category based on that. This one is with, so this one we are talking about how we can pass the entry. So first case, what we will do, we will, when we sell particular product, then what we do, we debit our AR customer account and credit to revenue side, okay. Then this AR has some positive balance. So now we need to reduce when we are factoring. So we'll credit AR simply and we'll debit cash, okay, whatever balance amount we will get, and we'll book loss also. What kind of loss? Interest related loss, factoring fee, and credit risk, like the person who is taking your AR, there is certain risk as I told you with regard to sales return, okay, and bad debt related, okay. So these are risks has to be reduced, and then you will receive your final cash, okay. So this would be the entry, okay. This will be debited and this two will be credited, okay. In this case we are just booking loss and reducing our AR, okay. In return they have given you cash, but since this cash is in your factoring account, okay, you cannot take this cash unless average period is locking period. For example, you have thousands of customer, okay, this is the company, this is your customer, there are thousands of customers. So normally you get your payment within 30 to 25 to 35 days, whatever it is, or maybe 20 to 30 days. And if you take average for all your customer, it is 25 days. So normally when you invoice, okay, average after 25 days you will receive your payment. So if this will be the locking period, so if you will take this cash and use, and then you have to book extra interest, as I have explained you, for 25 days whatever interest rate has been decided, that rate will be applied to you. So that will further reduce and you from your cash, okay, and in loss in that interest part will also be booked, and then you will receive. So that will come in later in Excel sheet, there I will also explain it to you. Okay, I hope it is clear to you. Thanks for watching, stay tuned, we'll see you into the next session. Bye bye, take care. Please do follow me on YouTube and Insta and LinkedIn. Okay, thank you very much.